You need to understand something right now. Everything we thought we knew about who controls the silver market, every narrative we built over the past 15 years about retail versus institutions, about the little guy squeezing the banks, it all just got flipped on its head. For over a decade, we've told ourselves a very specific story. We believed the bullion banks, led by JPMorgan, were the villains trapped in massive naked short positions. We believed that when silver finally broke free, like it's doing right now at $79 per ounce, they'd be destroyed. We thought we were squeezing them into bankruptcy. We thought this rally was their funeral. We were wrong. Dead wrong. They weren't getting squeezed, they were positioning. And now we've just received intelligence that completely rewrites the entire history of the silver market. It turns out JPMorgan didn't get caught in this rally. They orchestrated it. According to data now surfacing from detailed analysis of COMEX warehouse receipts and custodial vault records, JPMorgan hasn't just closed their infamous short position, the one we've all obsessed over for years. They've flipped the entire board. They're not short anymore. They're net long. And we're not talking about a modest position. JPMorgan is currently sitting on a physical stockpile of approximately 750 million ounces of silver. Let that number penetrate your understanding of reality. 750 million ounces. That's the largest private hoard of physical silver in human history. It exceeds what the Hunt brothers held in 1980. It dwarfs the custodial holdings of the SLVETF, which JPMorgan effectively controls anyway. It represents roughly 62.5% of the entire annual global mining supply. Think about what this means. For the last decade, while we were screaming about manipulation, while we were filing complaints with the CFTC, JPMorgan was quietly, methodically backing the truck up to the vault. Every time they smashed the price down with paper contracts, they weren't doing it to save the dollar or help the Fed. They were doing it to buy physical metal at a discount. They used their paper leverage to suppress our prices so they could accumulate the real asset for pennies on the dollar. And now the accumulation phase is complete. They have the metal. They have 750 million ounces of it. And if you own 750 million ounces of an asset, what do you want the price to do? You want it to go to the moon. This means the biggest whale in the silver market isn't a Reddit forum. It isn't a billionaire tech CEO. It's the very bank we thought we were fighting. JPMorgan has effectively cornered the global silver market. They've successfully executed the longest, most complex, and most profitable bait and switch in financial history. They convinced the world they were bearish while becoming the most bullish entity on the planet. And this explains everything. It explains why they stopped fighting the rally at $30. It explains why they let it run to $50. It explains why they're letting it rip to $79 today. They're not losing money on this move. They're making a fortune. Every dollar that silver rises adds $750 million to their balance sheet. The move from $30 to $79 alone represents roughly $36 billion in unrealized gains. This is the great betrayal. They betrayed the other banks. They betrayed the shorts who followed their lead. They left the smaller banks, Scotiabank, HSBC, holding the bag. JPMorgan exited the burning building years ago, locked the door from the outside, and is now standing across the street selling water to the fire department. The narrative has shifted instantly. We're no longer fighting JPMorgan. In a twisted, ironic way, we're now on the same side. We both want $100 silver. We want it because we seek truth in markets. They want it because they want profit. But the destination is the same. And when the biggest bank in the United States decides an asset is going to reprice, it reprices. They have the capital, the political cover, and now the physical inventory to make it happen. To understand how they pulled this off, how they managed to accumulate nearly 1 billion ounces without alerting the market, we have to go back to the beginning. This wasn't a plan hatched last year. This is a 15-year operation that was set in motion in the darkest days of the 2008 financial crisis. Most of you remember Bear Stearns as the first domino to fall in 2008. But you probably don't know the specific details of why they collapsed or what JPMorgan found when they bought the wreckage for $2 a share. Bear Stearns was the original naked short whale. They were the ones trying to kill silver. And when JPMorgan acquired them in that emergency shotgun wedding orchestrated by the Federal Reserve, they inherited a toxic waste dump of short positions. At the time, everyone thought this was a burden. Everyone assumed JPMorgan was doing the Fed a favor by swallowing this poison pill. But Jamie Dimon doesn't do favors, he does deals. He looked at that massive short position, roughly 200 million ounces of paper obligations, and he didn't see a liability. He saw a weapon. He realized that holding the largest short position in the market gave him something more valuable than money. It gave him control. If you control the short side, you control the ceiling. You decide how high the price is allowed to go. You become the governor on the engine. So instead of closing the Bear Stearns short, JP Morgan adopted it. They rolled it over. They nurtured it. They integrated it into their own trading desk, and thus began the 15-year accumulation strategy. For the next decade and a half, JP Morgan used that inherited short position to execute the most sophisticated accumulation strategy in market history. The game was simple, brutal, and effective. Whenever the price of silver started to rally, whenever retail investors got excited, whenever a new industrial use case emerged, JP Morgan would use their massive paper leverage to slam the price. They'd dump thousands of contracts into the market at 3 a.m. during thin trading hours. They'd trigger stop losses of hedge funds. They'd paint the charts red. Do you remember those days? Do you remember waking up to see silver down $3 for no reason? Do you remember the tamps? That wasn't bad luck. That was the algorithm. That was the Bear Stearns weapon being fired. But here's the twist, the part we all missed. While they were selling paper with one hand to smash the price, they were buying physical metal with the other hand to fill their vaults. They were the buyer of last resort. When they smashed the price from $30 down to $15, weak hands panicked and sold. Miners desperate for cash flow sold their production at spot. And who was standing there quietly in the shadows, scooping up every physical bar that hit the market? JP Morgan. They treated the silver market like a distressed asset. They artificially distressed it, and then they bought the dip that they created. It's the equivalent of setting your neighbor's house on fire and then buying the land for pennies after it burns down. It's ruthless. It's technically illegal, but it's brilliant. They built a private vault in London. They expanded their COMEX warehouse presence. They became the custodian for the SLV ETF, which allowed them to legally hold massive amounts of retail silver. Year after year, ounce by ounce, they drained the market. Sure, they got caught a few times. They paid a $920 million fine for spoofing a few years ago. The regulators patted themselves on the back. The media said justice was served. But to JP Morgan, $920 million wasn't a fine. It was a transaction cost. It was the cost of doing business. If you pay $1 billion in fines but make $50 billion in accumulation, you do that trade every single day. For 15 years, the suppression machine ran perfectly. They kept the price low enough to discourage new mining. They kept the price boring enough that retail investors lost interest. Silver is a dead asset, the pundit said. That was by design. They wanted it dead. They wanted it boring. Because if it was exciting, you would buy it. And they didn't want you to have it. They wanted it all for themselves. But every accumulation phase has a limit. Eventually you run out of room in the vault. Or more importantly, eventually the fundamentals become so overwhelming that you can no longer hold the beach ball underwater. That moment arrived in 2025. The structural deficits, the solar demand, the EV demand, the China situation became too large to ignore. JP Morgan realized the paper smash game was ending. The physical shortage was becoming acute. If they kept shorting into a true physical shortage, they risked blowing up. They risked becoming the next Bear Stearns. So they pivoted. According to the data we're seeing, sometime between June and October of 2025, JP Morgan executed the final stage of their plan. They quietly, systematically closed out the massive short position they'd held since 2008. They bought back the paper. They went neutral. Then they went long. They shifted their entire book. They took the 750 million ounces of physical silver they'd accumulated over 15 years and reclassified it. It's no longer a hedge. It's now their primary speculative position. Do you understand what this means for price suppression? The entity that was spending billions to keep the price down is now incentivized to spend billions to push the price up. The counterforce is gone. The wind is no longer blowing in our faces. It's at our backs. And it's not a gentle breeze. It's a hurricane. This is why the price teleported to $79. In the past, when we hit $75, JP Morgan would have stepped in to cap it. Today, they stepped aside. They let it run. In fact, they probably helped it, because every dollar that silver rises now makes their 750 million ounce stockpile more valuable. Let's do the math on their profit. They accumulated this hoard at an average cost basis of probably $20 per ounce over the last decade. Today, the price is $79. That's a profit of $59 per ounce. Multiply $59 by 750 million ounces. That's roughly $44 billion in profit. And that's just at $79. If silver goes to $100, if it goes to $200, we're talking about the most profitable trade in banking history. When you actually run the numbers on this 750 million ounce position, the scale of what JP Morgan has accomplished stops being a trade and starts looking like a hostile takeover of the periodic table itself. Let's look at the most terrifying metric: global mining supply. Every single silver mine on Earth, from primary mines in Mexico to copper byproduct operations in Chile to lead zinc mines in China, working 24/7, produces roughly 830 million ounces of silver per year. That's the hard ceiling. You can't print more ore. JPMorgan is sitting on 750 million ounces. That's 90% of the entire annual mining output of the human race. Imagine if one company bought 90% of all the oil produced in a year. Imagine if one company bought 90% of all the wheat. We'd call it a monopoly. We'd call it a national security threat. But because it's silver, and because they did it quietly over 15 years, nobody noticed. They've effectively privatized the global supply. Now compare their hoard to the structural deficit. We know the world consumes about 1.2 billion ounces annually, while mining only 830 million. That leaves a deficit of roughly 200 to 250 million ounces per year. JPMorgan's hoard represents 3 to 4 years of that deficit. They're the only entity that can bridge the gap. But the most shocking comparison, the one that proves the game is rigged, is looking at COMEX inventories. COMEX is supposed to be the price-setting mechanism for the world. Right now, registered inventory hovers around 30 million ounces, maybe 40 on a good day. JPMorgan has 750 million. That means JPMorgan holds 25 times more silver in their private vaults than is available in the entire public exchange system. Think about the absurdity of that. The market thinks there are only 30 million ounces available. The price is set based on that scarcity, but the whale has 25 times that amount hidden in the dark. This means COMEX is irrelevant. It's a sideshow. The real market is in JPMorgan's vault. And this leads us to the concept of the float. By accumulating 750 million ounces, JPMorgan has effectively removed the float. That metal is not for sale. Not at $30, not at $50, and clearly not even at $79, because they're still holding. They've taken that metal off the table, they've sterilized it. So when Apple needs to buy silver for iPhones, they look at the market and see nothing. The mines are sold out. The dealers are empty. The only metal that exists is in the hands of an entity that doesn't want to sell yet. This creates a super squeeze. It's not a squeeze caused by a shortage of metal on Earth. It's a squeeze caused by the privatization of that metal. It's the De Beers diamond model applied to silver. And this brings us to the question every detective asks at a crime scene. Why now? Why did JPMorgan wait until late 2025 to finally close the short position they'd nursed for 15 years? It wasn't because they suddenly developed a conscience. It wasn't because they feared Reddit traders. It was because they looked at the calendar. They looked at January 1st, 2026. Banks like JPMorgan don't trade based on charts. They trade based on information asymmetry. Sometime in early 2025, their analysts in Shanghai sent a cable back to New York with a message that changed everything. China is closing the door. They knew months before the public announcement that the Chinese Communist Party was planning to implement the export license system for silver. They knew the details, the 80 metric ton production requirement, the $30 million credit threshold. And most importantly, they knew the intent. They understood this wasn't just a bureaucratic rule change, it was a strategic blockade designed to secure silver for China's solar and EV industries at the expense of the West. JPMorgan looked at this incoming blockade and realized something both terrifying and profitable. The moment China locks the gate, the West goes into immediate deficit. For decades, the West has relied on cheap silver flowing from the East to balance the books. We consume more than we mine, and we fill the gap with imports. If China, the world's largest refiner, stops exporting, that gap becomes a canyon. So JPMorgan had two choices. Keep shorting the market and get caught in the supply squeeze caused by China, or buy everything before the ban goes into effect. Hoard it in a private vault and wait for the panic to start. They chose option 2. They spent the last 6 months aggressively draining COMEX, draining ETFs, buying private stockpiles, racing against the clock. They had to get their 750 million ounces secured before January 1st. This is a pincer movement, a military tactic applied to finance. On the eastern flank, you have the Chinese government restricting supply to protect their national interest. On the western flank, you have JPMorgan restricting supply to protect their profit margin. The global silver market is being squeezed from both sides by the two most powerful entities in the game. And caught in the middle, the free market, the industrial user, the tech company that believed in just-in-time delivery. And this brings us to the kill zone. The entity standing directly in the crosshairs of this 15-year trap isn't the retail investor. It's the entire Western technology and green energy sector. Think about the business model of the last 20 years, the tech boom. It was built on a very specific, arrogant assumption. Hardware is cheap, software is expensive. Companies like Apple, Tesla, and Samsung built trillion-dollar empires on the belief that raw materials were infinite and disposable. They assumed commodities like silver would always be available at rock-bottom prices, kept low by the banking system's manipulation. They built just-in-time supply chains. They kept zero inventory. They laughed at stockpiling. They became addicted to the suppression. The very manipulation that crushed mining companies was a subsidy for Silicon Valley. JPMorgan was effectively subsidizing every iPhone and every Tesla ever built by keeping silver prices artificially low. But traps don't stay open forever. You let the animal get comfortable. You let it eat the bait. You wait until they're totally irreversibly dependent. And then when they have trillions in infrastructure that cannot function without silver, you snap the trap shut. That snap happened this week when China announced the January 1st export ban and JPMorgan revealed their 750 million ounce hoard. Suddenly, the just-in-time model is dead, replaced by not at any price. Elon Musk's tweet, "This is not good," was the sound of prey realizing the cage door has locked. He's not looking at a chart. He's looking at his production schedule for 2026. He sees he needs 50 million ounces to hit his EV and solar targets. He looks east. China says no license. He looks west. COMEX is empty. He looks at the mines. They're sold out. The only phone number left to call is Jamie Dimon's. Imagine the conversation. Elon calls JP Morgan, "I need 50 million ounces to keep the Austin factory running." Jamie Dimon looks at his vault. He looks at his 750 million ounces. He knows he's the only seller in town. Does he sell it at the spot price of $79? Absolutely not. He says, "Elon, I'd love to help, but it's a tight market. China is closed. The premium is, let's call it $150 an ounce." Elon has no choice. If he doesn't pay, the factory stops. The stock crashes. The empire crumbles. So he pays. He writes a check for billions to JP Morgan. The wealth transfers from Tesla's balance sheet to JP Morgan's. This is the revenge of the old economy. For 20 years, banks were boring. Miners were dead money. Tech was king. Now the people who own physical reality are charging rent to the people who live in digital fantasy. But there's one more victim in this story. One more entity being sacrificed to feed the new order. That victim is the US dollar itself. You have to ask yourself, why would a bank that literally owns the Federal Reserve as a shareholder bet so heavily on a metal that's historically been the enemy of fiat currency? Banks usually hate gold and silver because you cannot print them. So if the king of fiat, JP Morgan, is suddenly hoarding the king of hard assets, what does that tell you about their confidence in their own product? It tells you they know the game is over. This massive accumulation isn't just a trade, it's a lifeboat. JP Morgan isn't just betting on silver. They're betting against the dollar. They're effectively shorting the Federal Reserve note by going long, the only asset the Federal Reserve cannot dilute. Think about the timing. We have the China export ban starting January 1st. We have the repo spike of $17 billion this week. We have national debt spiraling past $36 trillion. Jamie Dimon sees the math. He knows the only way the U.S. government survives this debt load is to inflate it away. So he did what any smart predator would do. He exchanged paper dollars, which he can print for free, for physical silver, which is about to become the scarcest commodity on Earth. He used fake money to buy real money. And now that he has the real money, he's going to let the fake money burn. This changes the $100 price target from a squeeze target to a monetary reset target. JP Morgan's hoard creates a feedback loop. As silver rises, it signals inflation. As inflation rises, people dump dollars to buy silver. As people dump dollars, the Fed prints more. As the Fed prints more, silver rises faster. JP Morgan is positioned to profit from every step of this collapse. They're the arsonists who bought fire insurance before lighting the match. So how do we navigate the endgame that starts next week? Here's your roadmap for the chaos. First, expect a false flag smash. With the price near $80 and news of the JPM hoard leaking, sentiment is euphoric. The banks might try one last washout, dumping paper contracts to trigger stop losses, pushing price down to $72 or $70 to make it look like the rally is over. Do not fall for it. This is not a sell signal. It's a bear trap. If you see a red candle next week, smile. It's an invitation to buy at a discount to reality. Second, watch the premiums. If spot price drops, but physical coins and bars stay high or go higher, that's the signal the paper price is broken. In a true sell-off, premiums collapse. In a manipulated smash, premiums rise because smart money buys the dip. Third, prepare for the industrial panic bid. Sometime in mid-January, reality will hit supply chain managers. We'll hear rumors of force majeure from suppliers, delayed shipments. This is when Tesla, Apple, and others enter the market. Their buying won't be subtle. It'll be violent. They'll gap the price up $5 or $10 overnight. Finally, the exit strategy. People always ask when to sell. My answer is always the same. Sell for what? Do you want to sell silver? The asset JPMorgan, China, and Elon Musk are fighting over for dollars? Do you want to trade the asset going up for the currency going down? That's suicide. The only time you sell silver is when you're trading it for another real asset. Sell it to buy land. Sell it to buy a business. Sell it to pay off your mortgage and become debt-free. But don't sell it to put numbers in a bank account denominated in the currency they're betting against. We're witnessing the end of an era. The era of paper died this week. The era of just-in-time manufacturing died this week. The era of trusting the bank died this week. We're entering the era of the real. In this era, he who holds the gold, the silver, the oil, and the land makes the rules. He who holds paper derivatives gets eaten. You've survived the bear market. You've survived the manipulation. You've survived the boredom. You're still here, and you're holding the metal. You're sitting at the table with the giants. JPMorgan has 750 million ounces. You have your stack. Your partner's in the greatest repricing event of our lifetimes. Hold the line. Ignore the volatility. Watch the vault. The trap has snapped shut on the industrial world, and you're holding the key that unlocks their survival. The price is going to triple digits, not because we hope so, but because the mathematics of geology and the greed of the banking system demand it.